A tremendous amount of uncertainty on international financial markets. Many financial institutions are going bankrupt, and because the linkages between financial institutions across countries are strong, the risks can spread. An additional problem, of course, is that by their structure, financial institutions have a relatively small capital base and a big amount of assets and liabilities on top of it is the credit multiplier. So a loss on the capital can force a financial institution to drastically reduce its portfolio size, try to sell assets, and this can lead to very large cumulative price declines, which is what we are seeing now. There is lack of confidence in counterparts, and some assets have no market anymore. And we know that those assets will have a value eventually, but if banks need cash now and nobody's willing to buy them, we have a very serious problem. Well, actually, the evidence is that the monetary union has actually accelerated the process of integration. And both commercial, so on the trade side, and also on the financial side. I think the main reason is that you have basically the removal of currency risk. So for an Italian investor now holding a bond issued in Germany or issued in Italy is exactly the same thing. There is no risk of currency movements. One of the consequences of this has been a very large increase in cross-border holdings, say by Spanish residents in Germany, by German residents in Italy, by Italian residents in France, and so on. So a big internal effect of financial integration. But at the same time, the fact that the euro area is now a very big area, is with a GDP of the size of the United States, it also becomes a more attractive place to invest for people outside the union. And so overall, even the integration of the euro area considered as an entity with the rest of the world, not just inside the euro area, has gone up dramatically in the past 10 years. Emerging markets have done a lot of progress in sort of strengthening the structure of the financial system, in having more solid policy and more appropriate policy stance, both fiscal and monetary, and trying to strengthen the institutional framework, which has helped attract foreign capital. But clearly, when there are signs of institutional instability, you immediately see the consequences on external markets. Some types of capital may be a little bit less sensitive to that. For example, if you have a country which is a major commodity exporter, say produces oil, gas, you may have a lot of foreign direct investment in that sector, which can be to some extent a bit more shielded from some form of financial institutional weaknesses than, say, an investment in a bond market or in an equity market, where manipulation, other things can go on if the institutions and the regulators are not good enough.